Okay, this is the last video clip for the financial reporting class. Convertible bond in IFRS. Okay, let's come back to the slides when we discussed in class liabilities in IFRS. We have a distinction between GAAP and IFRS in terms of a convertible bond or bond with non-detachable warrants. The big distinction is the part of the equity value. Okay, under the GAAP, so regardless of how much cash proceed and the difference between the cash proceed, which is the issuance amount, and the present value, they record just all this present value, all this cash proceed, which is the par value of this bond minus discount or plus premium onto the debt. Okay, but under the IFRS, this debt value and the equity value, if it is convertible bond, and then the market price is different from the present value of this bond, which is the equity premium. So it must be separately recorded into the components of debt and equity in terms of fair value of the securities. Okay, let's practice. Company A issued 1,000 convertible bonds with 10% stated rate. Par value is 1,000. Okay, market rate 12% at discounted present value of $940,000. But the bond was issued at $980,000 because of the convertible premium that has the option to convert into the equity at a certain exercise price. How should the company A report the issuance of the convertible bond? Okay, let's go to the GAAP first. Rule basis. Okay, we don't follow this calculation, the value of $940,000, but we put only 980. Okay, here the cash the proceed is now $980,000. What was the par value of this bond? Now convertible bond. How much is that? Right, $1,000 par value per bond times 1,000 convertible bonds, number of convertible bonds issued. So $1 million is convertible bond, the par value, total par value. So the difference between two is, that's correct, that is financial accounting thing. Here, discount. This discount of this bond is the difference between the par value minus cash proceed. So $20,000. So how do we post this cash in? 980. That is the original cost, the par value. At the end of the day, the company A should repay this, not 980, but 1 million. And then the discount, $20,000. So the net book value of this convertible bond is $20,000. There's no the value into the additional paid in capital under the equity section. So regardless of how different is the between the present value, discounted present value, and the issuance price, we put all this discounted price onto the debt only. But IFRS is a little bit different. They follow principal basis, focusing on the value. Okay, that means that the company should record this issuance price, which is the cash proceed onto the cash, but the value, because of the value of this convertible bond option, we know what is the additional paid in capital part. Even though $940,000, how this company could receive $40,000 more than 980? That is the additional paid in capital, the equity value, convertible option value for this convertible bond. Okay, so how they generalize? We put the cash first, how much, which is the same as this cash proceed when the company issued. Then convertible bond is always the par value, 1,000 times $1,000 per one bond. And then here, now we have to put additional paid in capital because of this, because of the equity value option, convertible option. The present value and the issuance price is different. So 980,000 minus 940,000. Okay, so that is the additional paid in capital. Then, how much is the discount? Discount should be from a million, which is par value, now minus the present value. That is the principal amount, right? Principal means that when you calculate the book value, the par value minus discount is the discounted present value of this bond. So we have to put how much? $940,000. Okay? Or you can just plug in the sum of these two values minus actual cash proceed is the discount amount. Okay? The same result. But I want you to follow this way to understand the concept of this discount. So let's put this journal entry into the financial position under the IFRS. So cash 980, and then convertible bond 1,000,000. Now minus $6,000 discount. So the book value of this convertible bond, the net amount is different from this, right? Where is the $40,000? Now additional paid in capital, $40,000. The value of convertible option to equity is $40,000. So should be presented onto the financial statement position, financial position under the GAAP, under the IFRS. Okay? Yeah, very simple exercise. Okay, congratulations for all this course, and then see you in the next video clip after the other courses. Bye bye.